But while John is a decent guy, that's not why I want him up here right now. I want him up here more in the role of a pit bull. Because as I said, he'll be moderating a debate that will do nothing less than grapple with the very efficacy of the corporate responsibility movement. So enough about the end of days, ladies and gentlemen. If you have an opportunity, do vote your answer prior to the debate, and then we will ask you to cast your vote after the debate to see whether any minds have been moved, and we will be announcing the results of the debate vote later this evening. I forget exactly what time, but toward the end of the day. So without further ado, John Harwood.
But we are fortunate to have a terrific panel here, which we've conveniently divided into good guys and bad guys. And they really detest each other. So I will try to keep it civil and everything, but I think it's going to be useful. Let me start with the good guys. Paul Herman is the author of The Hip Investor, and he's going to be advancing the proposition that, in fact, corporate responsibility is not inconsistent with the economic value of corporations. And he'll be joined in making that argument by Vinay Nair, who is also an author of a book called Investing for Change, published by Oxford in 2009, that talks a little bit about social variables, extra financial variables that ought to go into an investing strategy. They will be confronted bitterly by Anil Karnani, who is with the Michigan School of Business. He is the author of Fighting Poverty Together. So he has some redeeming qualities, as evident in the title of that book. He has just met this morning his colleague in making this argument, who is Jerry Sullivan. Jerry runs something called the Vice Fund. Let me repeat that, the Vice Fund. Okay? The Vice Fund goes for unsocially responsible returns in sectors such as tobacco, gaming, alcohol, and defense. Now, we're going to have a fair debate here, but I'm just setting the table with that. I assume everybody's had a chance to vote, and if that is the case, we will start with 10 minutes of the affirmative argument that you saw on the screen, which is that corporate responsibility destroys shareholder value. Guys?
I'm going to stand up if you don't mind. Is that okay?
Sweet.
No. I think better on my feet than on my bottom. Clearly, the world faces many large problems. Environmental degradation, climate change, poverty, and so on. And I think the political ideology of the world has shifted decisively towards markets, being anti-government. People like John even make jokes about the government. And there is more and more faith in the markets. Now, this combined with shareholders pushing for more profits has given rise to a new religion of corporate social responsibility, that businesses will solve the societal problems and through a voluntary mechanism like this. And clearly, many of you believe in this idea of corporate social responsibility here. This is a congregation of people who've been converted to the new religion of corporate responsibility, complete with its high priests and rituals too here. So at the beginning today, Richard blessed you all and baptized you into being corporate responsibility officers here. I'm going to try to convince you that you've been sold a bill of goods here. There is no God. It's an illusion at best, and maybe a delusion too here. I think you should convert back to being a pagan and subscribe to secular values founded on two critical principles: shareholder value on one side and public regulation on the other side here. What we do not disagree about is the objectives we want to achieve. We all want the same objectives: clean environment, sustainability, social justice, and so on. The key question is, what is the means to get to that objective? And I don't think it's corporate responsibility. I think the means to get there is shareholder value and public regulation. Yeah. And I'm going to try to make that argument with you. I'm going to argue that the whole idea of corporate social responsibility is a very confused idea. In fact, that's why you see so many words used for it. Corporate social responsibility, corporate shareholder value, shared values, social philanthropy, social enterprise, double bottom line, triple bottom line, creative capitalism, conscious capitalism. They don't know what they're saying, yeah, basically. Yeah. I'll argue that CSR is irrelevant, it is ineffective, but more importantly, it's dangerous too. Yeah. The starting point is that the whole CSR idea confuses two very distinct and very different situations. So I've got a very simple 2x2 matrix here. An activity that a business undertakes can be profitable or not profitable, and it can be virtuous or not virtuous. Now, the purple boxes are where the private interests of companies and the public interests of society are aligned together. So that you do something profitable and it's virtuous. You do something that's not virtuous, it's not profitable. And this is one type of situation that we'll talk about. A second situation is in the yellow boxes, where the private interests of companies and the public interests of society are in conflict, actually. It's not a win-win situation. That to do something virtuous, you have to lose some money, or you can make money by doing things that are not virtuous. We should clearly distinguish these two types of situations, the purple boxes versus the yellow boxes. So in those purple boxes, where the interests are aligned, I call it the zone of opportunity, because private and public interests are aligned. So of course a company should look after its employees and engage them. Of course a company should listen to its customers and give customers what they want. Of course a company should try to reduce energy consumption and cut costs in the same bargain. This is what we at the business school call good management. That's it. You don't need to be canonized for this. Society doesn't need to give you brownie points. Shareholders should reward you for being a good manager who makes more profit. End of story. Yeah, that's it. There is no reason to talk about CSR here. Yeah. This is just good management. Now, of course, I'm making a critical assumption here, which is that managers are competent, they are long-term oriented, and acting in the interest of shareholders. This applies to everybody in this room, but there are managers outside who don't follow this basic assumption. Now, if you want to fix that situation, the solution is not CSR. The solution is better corporate governance. So if there are shareholders who should insist that their managers create value in the long term, who should insist that managers act in the interest of shareholders, who should look at the broad picture. We don't need to bring in society into this. This is why capitalism is such a wonderful institution. This is why capitalism works. Many 100 years ago, more than 100 years ago, about 300 years ago, Adam Smith wrote the book Wealth of Nations, where he said, we don't rely on the baker to provide us bread out of the goodness of his heart. He does it because it is his self-interest to provide us bread. We get bread, markets work. And when markets work, we do not need to raise CSR. It's irrelevant. Now, this is not so bad. The bigger problem is that CSR is actually dangerous now in this situation where markets are working, because it tends to demonize business. The idea is that business needs to put back into society something. But that assumes that business is taking something out of society. This is clearly a fallacy. Business is good for society. It is a part of society. And they don't need to put anything back in. Yeah.
Anil, I just need to give you a time heads up. You're 7.5 minutes, and Jerry's got 2.5.
Okay. We'll go quick. So CSR is just a policy of appeasement and undermines the basic institution of capitalism. Now, in the yellow boxes, where the public and private interests are in conflict, now we need government regulation. CSR will not work. Companies will not voluntarily reduce their profits in order to achieve some good. Yeah. And much of CSR focuses on the trivial issues, like Walmart uses LED lights to reduce energy consumption. This is a good thing. Yeah. We don't need to call it CSR. It reduces costs. It's good for the environment, but it reduces costs and increases profits. That's it. But when Walmart acts in an anti-union manner, this will not be solved through CSR. We need to decide whether we need government regulation or not. Yeah. And in these situations, CSR is ineffective. It is also dangerous because it leads to greenwashing. It's interesting that if you had been here a few years ago and talking about the oil industry, the company that was seen as the most socially responsible company was, of course, BP. It had won several awards for social responsibility. They changed their logo to a sunburst. They were going green. And they changed the name from British Petroleum to BP. BP was supposed to be beyond petroleum. Today you know that actually petroleum is beyond BP. And the way to get BP to be responsible to the environment was to tell them that we'll penalize you for any accidents. That would do it much better. Exxon is a company that never talks about CSR, but implements good safety procedures because it is in self-interest to do so, not because of CSR logic. Now, you might ask, if CSR is so flawed, how come it's so popular then? Why are there so many people here? Well, one is because I think the social activists who would want to achieve some social objectives have given up on the political mechanism because they think the government doesn't work, politics doesn't work, so they have resorted to talking about CSR. So instead of getting a cap and trade bill or a carbon tax, they're telling oil companies, please be responsible. On the other hand, companies see this as a way to appease social pressure. Everybody talks about it, but they do very little. There's a lot of greenwash going on here. It's a seductively appealing idea because it sounds like a win-win solution. We will cure the world's problems and become rich in the bargain. You have to confront the trade-offs. That's why life is difficult. And there is a whole industry of CSR that has grown up around it. Managers with titles like Corporate Responsibility Officer, conferences, magazines. This is a self-perpetuating industry that doesn't serve much purpose. So what's the solution? When markets are working, when they're efficient, leave them alone. Capitalism works. When markets are failing, like in the case of pollution, you need mandatory government action, not voluntary corporate action. And we need to strengthen the role of the government rather than deriding the government. We get the government we deserve. And if you keep making jokes about it, you will get a joke in return too. Yeah. Thank you.
All right, guys, since I think we should keep to time, the bad guys have turned on each other, and Anil has consumed all of Jerry's time, but Jerry can make it up in the question and the rebuttal because we're going to have another period later.
So are we saying self-regulation didn't work?
Exactly. It did not. So the heavy hand comes in. Let me ask you just to follow up, and Jerry, I'll put it to you since you've been mute so far. What do you do about aspects of profitability that might not be immediately discernible or measurable? Goodwill that you build up, or preparing a company for changes in the economic facts on the ground that might occur later when Congress acts and imposes a regulation or a carbon tax or that sort of thing. How do you value that, and how can you be confident that all of the sustainable and responsible activity until that point is destructive of shareholder value?
Well, I think there's definitely a trade-off between long-term and short-term profits. And what I've been able to find out as I've researched the other side, in the sense of, I found that long-term profits seem to be a buzzword for, we're not making money now, but we will in the future. And I think there is investment.
But does that always have to be true? I mean, maybe sometimes they will make money in the future.
Yes, but if you look at the average gambler who's at a craps table or at a card game, and they're running low on money, they're waiting for the next hand, the next roll, the next something, and eventually you crap out and you have no money. And I think, unfortunately, the reality is that you do need to make short-term profits, and that a truly good manager who's aware for the shareholders of the company will balance that out. He'll trade off some short-term profits for the long term, but in reality, he's there to shepherd for the shareholder and not the stakeholder.
But okay, so if you accept the principle that you manage and you sacrifice some short-term for long-term, it is possible that some of the long-term that you're sacrificing for falls into the realm of sustainability or, more broadly, corporate responsibility, yes?
Yes, and yet again, I would think the average corporate leader wants clean water, clean air, and won't damage, he'll try their best not to damage the environment. Yet they do still have to make a business, and they still should generate wealth for the shareholder, who is the one who really owns the company. And I think what's happened with certain institutions is there have been boards of directors and CEOs that have taken the company away from the shareholders in many ways, and have pushed the company down into making decisions that are not made for the shareholder.
What is the value that you ascribe to shareholders for goodwill that might accrue for a company among certain segments of the population, even if you can't monetize it initially? I mean, I'm thinking of the greenwash stuff that you were talking about. There is a segment of the population that finds that appealing. How can you impute economic value to that, or can you?
I think it's hard. It doesn't come. It ends up being part of marketing, and it doesn't end up in the financials. And I'm basically an asset manager, and I have to make a living on having my returns beat a benchmark or attempt to beat a benchmark. So maybe my focus is short term, but I also know that when you invest in good companies, if you do it in a well-diversified manner, in the long run things work out.
Let me ask you, Anil, a variant of what Jerry and I were just talking about. How do you assign value in the following circumstance? I believe the world is in slow motion, moving toward action on, say, climate change. Okay, don't know what form exactly that's going to take. Whether cap and trade will expand beyond the extent to which it exists, or carbon taxes where we go, but something is going to happen over the long run. And until those things happen, and the price signals that result from those occur, it may be impossible for companies to take advantage. But how do you value what a company does now in advance of those signals that they cannot reap an immediate return from? And does that fall into? Could that fall into the corporate responsibility space?
No, I don't think so. So let's take energy as an example. I think there are conflicting pressures on how we generate our energy. For the sake of climate change, we should worry about one set of issues. But for the sake of stimulating the economy, which is another priority for the US, we worry about a different set of issues. Then there is a third set of issues about energy independence, which is different. Now, if you burn coal is the cheapest form of energy. It's good for stimulating the economy, but it's terrible for the environment, but it's good for energy independence. If we burn oil is better than coal for the environment, but it's worse for energy independence of the US. On the other hand, if we go to wind energy, it'll be great for the environment, it'll be great for energy independence, but it'll be terrible for stimulating the economy. There are tough trade-offs to make here. These trade-offs have to be made in the political arena, not in a corporate boardroom. I don't want the manager of a coal company deciding.
No, but I'm talking about the interplay of both of those things. I'm talking about when you have a political process that is moving toward a result but hasn't gotten there, and a company takes steps that are consistent with the aims of the corporate responsibility movement, but that cannot be monetized now until the political process acts, not as a substitute, but as an adjustment in advance. Well, how do you value that?
I think the market does it all the time, which is it calculates the net present value of future cash flows. It assigns a probability there and says, are you maximizing a probable profit in the future? And the market is perfectly capable of doing that. The same logic applies to investments in technology and investments in consumer markets. We don't know what the future will be like, but the stock market is capable of monetizing future profits today by discounting them to today's year. So pharmaceutical companies invest for 20 years in the future, but the stock price goes up today or not.
Terry, let me ask you one more question before we go to the good guys. how do you accommodate the possibility that the movement that is present in this room and the idea that we're debating of corporate responsibility could change political facts on the ground to produce the sort of regulation that accommodates the public welfare and changes the economic context for the corporation?
Ultimately, corporations could go out of business. And if the corporation cannot make money or their business model changes, they have to...
No, but I'm talking about if in a different... Assume that the corporations are going to make money in any context that they're operating in.
Okay.
But if the corporate responsibility movement results in multiplying by 1,000-fold BP in the sunburst, notwithstanding the Gulf oil spill, or GE, the company that I worked for until we were bought out by Comcast, sort of eco-imagination and the whole business about what light bulbs you can buy in your department store. If all of those corporate efforts, in fact, have an interactive effect on politics, regulation changes, and then you have a new context in which to evaluate the shareholder value for the company.
I guess that it ultimately will end up with the market will price the companies differently. Either a company that does that well and makes profits, it'll discount the cash flows and the price will go up. GE is actually a great example. One of my slides showed GE with Jack Welch. Jack Welch supposedly lived under two rules. One, to deploy capital, and the other to promote the top 10% and fire the bottom 10%. And GE did tremendously well, beat the average significantly. Then Jack retires, Jeffrey Immelt takes over, and the stock has tremendously underperformed. And in the middle of it was eco-imagination, where in 2005 he quoted as saying, "Green is green." Well, if you bet with GE, you had less green. So the market has priced GE. They may be doing it right now. They have a cute ad campaign about a girl and her mother. But I don't know whether or not they go, again, the market will price them better in the future. If so, the question comes down, they failed for so long, why do we give them a chance to win after they failed? Or why do we give management? And it comes down again to management. And if a manager does well and the company does well for society and it's a kumbaya moment, that's wonderful. But I've kind of got the understanding and learned that during kumbaya moments and the group hug, the first thing you look for is your wallet.
Guys, we're going to start with the negative argument to this proposition. Which one of you guys is going to start?
I'll go first.
Take it away.
Thanks. And first of all, I want to thank Jerry and Anil for agreeing. I don't think they're bad guys, but I do think that they are ill-informed and their views are potentially dangerous. So what we'll show you here, hopefully once the slides pop up, is
the
that
veneer's coming off now.
The resolution that corporate responsibility can erode or destroy shareholder value is false. And just quickly, both Vinay and I are full-time investment managers and part-time lecturers and academics. Please read these disclosures. Past performance is not indicative of future return. Check with your investment advisor. This is not an offer of securities. Okay, so 21st century responsibility. I think what Anil and Jerry have been describing is 20th century responsibility around policy rather than results, and around maximizing profit, like Milton Friedman said, not maximizing stakeholder and shareholder value. So we see solving human needs, doing good, being how you create profit, and it's actually a new lens for 21st century sustainability, so that when we're here together in 20 years, we will be celebrating all of the shareholder value. So what you can do from a strategic point of view, which was not addressed in their point of view, is when you actually solve human needs in health and wealth and earth and equality and trust, when you start from that position by solving those problems, GE's largest growth is actually coming from healthcare, infrastructure, and solving problems on the ground for millions going on billions of people. The reason why GE's stock price is down is they were over-leveraged in financial services and were not as aggressive at managing risk as some of the banks are. So other examples of top-line revenue growth include PepsiCo. So PepsiCo classifies its revenue into good for you, better for you, and fun for you. So fun for you is still 70%. Those are Chips Ahoy, Doritos, things like that. But good for you are Quaker Oats oatmeal and Tropicana orange juice. And Campbell's Soup has actually done a great service in bringing traditional investment people and traditional sustainability analysts together and quantifying their revenue by the milligrams of sodium per serving in each of their products. So more than 30% of Campbell's revenue is now healthy, nutritious, and positioned for wellness. So 2/3 of customers actually want to do good with their purchases. And more than 1/3 will tell a friend. So if they're happy, they will be contagious and grow revenue faster. And if they're unhappy, they will tell. And so that's what gives websites like goodguide.com, which you can also get on your iPhone app, a chance to do that. Investors, the same way, 2/3 of individual investors see doing good as a positive indicator. Unfortunately, 2/3 of institutional investors do not. And that is their incomplete and incomprehensive view today. So what we'll show you throughout our discussion, once this clicks, is that shareholder value, and this comes from published in MIT, the BCG matrix. This shows you how you can actually generate higher shareholder value through things known as corporate responsibility, sustainability, and the like. So the numbers are proving this out. Socially responsible investing is on the rise. Sustainable investing is even on a higher rise. And the number of investors, and this includes institutional investors that are focused on environmental and social areas, is large and growing. So I will turn it over to Vinay with plenty of time as our teammate. We're integrated here. We are showing the 21st century
what I told
model. We're not like the 20th century model of siloed profit and siloed academia. We're integrating them together.
Thank you, Paul. So I think Paul walked you through some examples, then he has plenty more, I know, that show that social responsibility enhances profits, improves corporate profitability. And I think it's more than a semantic issue. So Anil's criticism is that that's business, and why should we really emphasize on social responsibility being the source of that higher profit? And I think, of course, we can say let's do better business, but we can also say let's do better business by paying attention to some social factors. And I think some of the importance Paul will talk about again, but I want to pick up on something else, which is it's not an oxymoron. Social and profitability doesn't have to be, and even when it is, it can be actually value enhancing. So in other words, by the way, my favorite oxymoron is this, and I think U.S. food industry's bunch of oxymorons like jumbo shrimp, 12-ounce pound cake, but social investing is not one of them. And if you look at the food industry here, these are growth rates you see in a place like India or China. This is thanks to Pegasus, the private equity firm. And in fact, these are growth rates in the U.S. within these sectors. If you look at the sectors, these are all sustainability segments of various sectors: food, electricity, fuels, healthcare, so on. And the growth rates look like it could be an emerging market. Okay? So clearly there's profitability here, and if you go and tell a corporate manager, let's use this lens of social responsibility to detect how we can create business value, I think that goes a step beyond just saying be a better manager. So that point aside, I do think that many social investors are shooting themselves in the foot by emphasizing social more than returns, and needlessly. But 21st century responsibility, to me, has moved on. 20 years ago, we had two fringes. One, which was ethical investing, which focused on values, preferences. If you didn't want to invest in alcohol, great. It was really not a question anymore about returns or not returns. On the other extreme, the other fringe is really people who use responsibility as a marketing gimmick, as a PR device, as a branding tool. And I think where we are today is really the bigger center, which is corporate responsibility, and I prefer to use the term sustainability, just to stay away from the last 20 years, is really the center. And you can criticize the left of this ethical investing approach. You can criticize the right of the PR approach. And a lot of the criticism that Anil actually has, I think, is directed to the two corners. Where we are today is the more mainstream, bigger audience, I think, of sustainability improving valuations. So before I just talk about this, I want to point out one important thing, that you can have lower profits today and still have higher valuations. Because what shareholders care about is not just today's profits, they care about the duration of profits. And I could have a business that generates 100 million today and vanishes tomorrow. Or I could have a business, the same business, that takes 10 million of that 100, puts it into safety standards, and generates 90 today and 90 tomorrow. Obviously, the shareholders value the 90 plus 90 more than the 100. Now, in a nice theoretical experiment, and I used to teach at Wharton full-time, markets are nice and efficient, but now when I move to the real world and try to invest, it's not so clear. In fact, corporate governance is a great example. In early 90s, a few funds started investing in companies based on corporate governance. Everyone said, why the hell? It's just part of normal management. They generated good returns for the last 13 years, from 1990 to 2003. Enron happened, WorldCom happened, markets priced it in. It took markets about 15 years to learn the importance of corporate governance. And it'll probably take another 15 to 20 to learn the importance of, say, extra financial variables, social variables. So we ran this experiment when we first started our fund, and it's an experiment, but with real money. We took all our financial models and ran it in one fund. We took the same financial models and incorporated sustainability onto it and ran it in another fund. Put real money into work, got the results audited, ran it for 2 years. Because I had never seen in my whole academic career, teaching at NYU, Columbia, Wharton, a good study which showed whether these things improve returns or not. Because sometimes the sectors are different, the size is different, risk factor exposures are different. So we wanted to create a control experiment as close to what we could do, and we ran the two funds in parallel. Over the last 2 years, there's some outperformance for the sustainable version. I don't consider this convincing evidence of the fact that sustainability improves returns because it's not long enough. But I view this as convincing evidence that it does not destroy returns, okay, at least at the most conservative manner, and probably the cleanest evidence I have seen, if I can say it myself. So where does all of this leave us? I basically think that you can have lower profits, higher valuations. Shareholders care about value, not profits. A lot of the corporate investor relations departments should focus on duration of profits rather than how they're changing the world. If you can translate how you're changing the world into telling that analyst on Wall Street how this translates into more stable profits, and that you are not Manville Corporation, which went bankrupt in '82 because of asbestos litigation, in spite of being number 181 on the Forbes 500 list overnight, that is good for shareholders. You can get a higher value by investing in a company that's going to remain for the next 30 years and not vanish. Massey Energy learned it the hard way, losing about 50% of its shareholder value. And these are all things which you can predict to some extent by using extra financial information. There are many other ways you can predict this, but extra financial information happens to be one we have today. You can call it social or otherwise, but I think that if there were other sources of predicting the future duration, stability of profits, we as investors would use that too. So I think when you combine the fact that markets learn, they have throughout history, combine the fact that valuation and profits are not perfectly aligned, there could be discrepancies, combine the fact that social responsibility is now more mainstream from your investor relations approach or from your ethical approach, I think we are entering into an interesting period where this could have an influence. And the last thing I would say is I think Anil overestimates the power and intent of governments. The best example is in the 60s when state regulations came into existence about pollution standards. All the factories moved from one state which had tougher standards to another state which had weaker standards or more lax rules because it was cheaper. So you could have a race to the bottom among governments, could be among states in a country or between countries in the world. Corporate tax rules are a great example. Ireland cuts tax rate to attract business. Guess what? Another country can cut tax rates further. Result, tax revenues which government might use from business to do some good goes away. So I'm not so sure that they're substitutes, firstly. And secondly, I think both have their own failures and problems. Governments compete to attract business. Businesses are more mobile. So at the end of the day, who governs the business? And I think it has to be a universal owner, which is the shareholders. So if shareholders, such as the UNPRI mission, or public pension funds, or sovereign wealth funds, who have a broader objective, start pricing in these extra financial variables, managers would cater. I think managers will cater because obviously they care about prices, but they also care about loyal investors. And among this group, you have long-term investors. These are exactly the kind of investors you want as your shareholder base. There's some evidence in finance that when you report a negative quarterly earnings, the shares prices fall lesser when you have long-term investors. So as a corporate CEO, you have now the freedom of coming up with a longer-term vision, a longer-term plan, and a loyal shareholder base that will help you try it out. Okay. So I think for several reasons, managers should cater to investors who care about extra financial variables. And these investors are only going to grow largely because most of the money being managed today is public money from the sovereign wealth funds and public pension funds of the world. So like it or not, I think these things will come into account. And from our perspective, I'm glad they're coming into account.
Thank you, Vinay. One small observation about the way General Electric and eco-imagination is affecting those of us down at the bottom of the food chain. They provide free coffee at every NBC entity, but they've taken away the paper cups. So there is a constant search around, like the NBC newsroom in Washington, for somebody's stash of paper cups. Most of the people learn over time to bring their own mugs in, so that's a small contribution. Paul, let me ask you this question, having heard Vinay's presentation, and that is, I'm wondering if you guys are not conceding their point. That is, Vinay was making the argument that you drive value even if at the expense of short-term profits, which doesn't sound to me inconsistent with Jerry's argument that you take a lot of economic factors into consideration, but ultimately it's economic factors. If you make your argument on the basis of shareholder value, don't you agree with their proposition?
Well, I think, so what you'll see in the actual reality and the evidence is the question is, when are you counting the valuation? So what we'll show you when we present our argument is that there's a time difference from when you learn information about sustainability, human, social, environmental factors, and when it actually gets priced into the stock. And it could be 6, 9, 12 months before that happens. And that's been shown in academic evidence by Alex Edmonds at the Wharton School, where Vinay and I are both affiliated, as well as in reality in our own portfolios. So at the time that it happens, it is possible for the market to discount those factors. And it actually, for you as an investor, you can arbitrage that. So despite learning in financial theory that all available information is immediately priced into the stock as soon as it's released, just doesn't happen. Otherwise, everyone should buy 100% index funds because there's no way you could arbitrage that. The reality is that for a short period of time, many times, the market, in all its fine reality, does discount it. And then a couple quarters later, when there's a surprise cash flow from these initiatives, employee engagement initiatives, environmental remediation initiatives, then there's a continued premium after that point in time.
Well, so is your argument then that doing good is always also doing well, that there is no divergence between the two, and that nobody should congratulate themselves on moral, ethical grounds for doing good, because, in fact, as Jerry and the Vice Fund prove every day, it's all about doing well?
Well, just to distinguish that, I mean, if you're truly doing good and you can quantify that impact, and what we don't have today are great quantifications of impact. So what we do at HIP Investor is actually quantify that impact from a product and services point of view, and operations and supply chain, and how decisions are made differently inside an organization, how you allocate capital differently based on that. So Alcoa actually embeds triple bottom line criteria into their capital expenditure process, so that if there are environmental or social risks, they will rework the capital project, $5-10 million capital project, to do that. So doing well and doing good should be equivalent if everybody were doing it. Unfortunately, it takes time to change, to undo those mindsets, and to adopt them. So ultimately, Vinay and I will have to find a new methodology as this becomes more and more common, which is happening today with more and more speed and more scale.
Jerry's view is that there is a division of opinion between your side of the argument and his, between whether or not a company is responsible exclusively, in effect, to shareholders, or whether it's responsible to other stakeholders in the society. I thought I heard Vinay just say that, in fact, they are exclusively responsible to shareholders, which, again, strikes me as a convergence between the 2 points of view.
I think the divergence arises from basically thinking of doing well differently. I think often people think of doing well in terms of profitability. But when you start thinking of doing well in terms of shareholder values, those two don't have to align themselves. Now, what happens in practice, so in theory, yes, we are aligned, but in practice what happens is people assess today's profits and link it to shareholder value. In reality, shareholder value is today's profits plus tomorrow's profits. So sometimes you see divergence, and that is part of the reason you see market inefficiencies and failures of shares being mispriced by assessing future profits incorrectly. So I think what Paul is saying is that in reality, when you get down to investing, you can actually come up with better estimates of future profits by looking at these social aspects. So what Jerry would say is, in theory, we should all care about profits. I would disagree. I would say we should care about shareholder value. Then we both agree in theory. But in practice, to implement it, we have to look at both social aspects, financial aspects, and extra financial aspects.
But sort of just to reframe, it is like Billy Beane in the Oakland A's. It is a different kind of money ball, but it's still money ball. It's not moral ball. Yes?
In spite of not knowing baseball, I think yes.
Have you been to the movies this weekend?
It's like money cricket. Yes.
Yeah, nice. Let me ask you about one issue which has chastened a lot of liberals in Washington. It's not a perfect analog because it involves the interplay of government and business, but Solyndra, the solar energy company that benefited from a federal loan guarantee, sort of as Anil was suggesting, it was an attempt to, in the absence of a real price signal in the market for the product that they were making, an attempt by government to sort of goose it along. And it was with a social purpose in mind, and it was a total failure in the actual marketplace. How chastening is that for your movement and other examples like it, to think that, yikes, maybe it's not economic?
Not at all. I think it's irrelevant. Now listen, I'm an economist. And we are not proposing going back to your socialist central planner allocating contracts. It's very different. I think when you do that, you have cases like this, backdoor corruption, lobbying, various situations that emerge from it. What we are talking about is basically saying that these are not substitutes. If iron goals are the same, these are complements. Private markets and...
Doesn't lobbying by activists fuel the corporate responsibility movement?
Both ways, right? I think in some ways, let's say that regulation is indeed the way to get to the end result. Regulation doesn't arise from a vacuum. There are incumbents who oppose new regulation, and then there has to be lobbyists that propose new regulation. It turns out that often the corporations are leaders in coming up with new regulation too. I think markets create a population that starts funding an opposing force, and eventually you have two lobbying forces, and social norms dictate, and new regulation emerges. This is not functioning independently. In business schools, you have a different department for finance and political economy. In reality, they don't function independently. So I think that financial markets, by aggregating information and predicting future regulation, actually helps create that regulation by creating an opposing lobby to the incumbents. And then it's an issue of predicting the political game that goes on. But broadly, I think the key point is we are not proposing moving back to a central planner. All we are saying is governments have the limitations due to lobbying, both sides, due to competing with other governments, and private markets can address some of those limitations, not substitute them, but I think they work as complements to each other.
If we had a second follow-up, Anil and I could take one side, and maybe Jerry and Vinay could take one side, in that there are multi-sector solutions. So the Solyndra situation, that's one loan out of a 40-loan portfolio. So 39 of the 40 are essentially performing. And Solyndra basically placed a technology bet, sort of NASA-esque or DARPA-esque, on a technology that just didn't keep pace with the China subsidies. So like Vinay's saying, on a global level, we have to look at where capital's moving. And so China clean tech has essentially come up and exceeded US clean tech in less than 2 years. And so that's the global playing field. So understanding what the sectors can add in each of those.
All right. Having heard and consumed an hour of our time with the Tea Party argument and the liberal European socialist argument, we're going to move into the closing arguments, and I'm going to impose a 5-minute instead of 10-minute, as we had planned, time limit on those, so we have some time for questions from the floor. Guys?
Being a market participant, I looked at history and tried to find a corporate responsibility index. Well, the Paul has one, but it doesn't have a long enough track record, and it wouldn't be fair to compare one way or the other. So I used the Dow Jones Sustainable World. And if you go back to 12/31/93 through the end of August, it had an annualized return of 7.01%. The S&P 500 was 7.6, so the S&P performed better. But not only do I manage the Vice Fund, but I have a patented investment strategy that follows shareholders' equity. So my argument was, you take the sustainability index on one side, and you have an index based on shareholders' equity, which is book value, and truly what's left after you take the company's assets minus liability. This index was up since 1993, and it was live 9.73%. So it significantly beat not only the S&P 500, but it beat the Sustainable World Index. And why? And it's because it's about owning good companies that do well, and do well for their shareholders, adding value to their shareholders, and if they don't, then they go out and they're replaced. And ultimately, I had a couple quotes that you probably will never see ever together again. But my one question I had was, how does this compare to socially responsible mutual funds? Well, now I'll use my position as portfolio manager of the Vice Fund. I don't smoke, but I invest in tobacco. I drink. I'm Irish, so I invest in alcohol. I don't like to bomb people, but I've heard that we need to, from both sides. So we own defense stocks, and the other is gaming. These four together actually have performed since the end of 2003, up 8.1%. versus a basket of SRI funds, which is up 4.58%. So statistically, it doesn't, I would say CSR is a bad investment. I have analysis about why. But ultimately, why do people still invest? We have now $300 billion in SRI funds and SRI mandated things. And I found this lovely conservative philosopher named Frank Zappa, who said, some scientists claim that hydrogen, because it is so plentiful, is the basic building block of the universe. I dispute that. I say that there is more stupidity than hydrogen, and that is the basic building block of the universe. And now, unfortunately, people with their money, if they don't do well, they should have less money. And ultimately, over time, that will wash itself out. But it seems like they do have a significant amount of money, and it still grows. And to this date, I unfortunately would say that the investment strategies that we follow benefit the corporations, benefit the shareholders, and that I am ambivalent about the stakeholder. That truly, as a shareholder, I believe that I want profits to be maximized to the extent of what is good. And I do believe that the average responsible CEO will do the right thing.
So, all right. So, and if you're not yet tweeting, you can tweet at #CommitForum. And feel free to Facebook as well. So what Vinay and I do as investment managers, and we've written about in books, we've open sourced this. Again, 21st century sustainability is around transparency. And just a reminder about the disclosures, is that we focus on, here are the factors of how you drive value. So quickly, think to yourself, what is your company's most important asset? Anybody want to answer? People? Any other answers? Employees? Any other answers? Okay, intellectual property. So I heard the most answers for people, so we'll go with that. So here's a question for you. Go down to your CFO's office or investor relations and ask them, where are people on the financial statements? Anybody know where they are? Expenses on the income statement, liabilities on the balance sheet. If you do good acquisitions, you might have them as goodwill. But essentially, they are not on the balance sheet as an asset. We are intangible assets off balance sheet, just like the Iraq and Afghanistan wars. There are 16 companies, all based in India, who do something called a human resource valuation. And so if you go to their annual reports, not the sustainability report, but if you go to Infosys, you will find in the annual report first a 10-page letter about talent from the chief mentor, Narayana Murthy, and you will find deep in the footnotes this human resource valuation. So I encourage you to check it out, share it with your CFO and investor relations, and when you do this, please let me know so I can talk about you on stage. As of now, there are no US or European companies who are doing this. And so essentially the value of intangibles, and we are intangible that walk in and outside of the door every day, are more than 80% of the stock market value. Only 20% are physical assets. And so there's a ETF, actually. This is not a recommendation. This is for your information. But Ocean Tomo has put together an intangible value ETF. It's been running for 5 years, and it has outperformed the S&P 500. You may have seen Fortune's Best Companies to Work For. You may work for some of them. So this has come out every year since 1998. Alex Edmonds at Wharton actually studied this as an academic paper. He's one of the few in the Wharton Finance Department to do this. We all need to support him some more. Does the stock market fully value intangibles? Anybody want to guess? No? Anybody say yes? There's usually one. So here's the results. You can find this on the Best Places to Work For site. On the right-hand side is the Russell 2000 and the S&P 500. So that's a 12-year annualized performance. And on the left-hand side is the blue bar, is if you bought the 1998 Best Companies to Work For, that would be your annualized return. And on the red line, if you bought them every year, sold the ones who fell off, that would be your return. There's a mutual fund called Parnassus that does this. They take a more active approach than just the index. I encourage you to check it out. It's got 5 Morningstar rating. And when you examine your board and board governance, you should always examine your diversity. Procter & Gamble former CEO Alan Lafley said, we cannot have a homogeneous workforce, we need a heterogeneous workforce. What you see here, provided by Catalyst, Inc., a nonprofit based here in New York, is on the left-hand side are the bottom quartile of Fortune 500 companies based on women on the board, many times 0. And on the blue bar are women on the board of directors, top quartile. So on a board of 10, anybody want to guess what top quartile women on the board of directors are? How many out of 10? 2 and a fraction. We'll skip over BP since we all know that. Puma now has an environmental profit and loss statement. You'll probably hear about it at the conference. They see that environmental and social factors carbon and water, if priced, would be 25% of their bottom line profit. This is the academic proof that we showed you before. You can find this on sristudies.org. You can see about a 9-month discount, which is also what Alex Edmonds found, before you have a premium after the news. This is in environment. Mutual fund like Portfolio 21 has beaten both the S&P 500 since inception and the MSCI EFA, the EFA ETF. And I do want to give cred to Jerry's Vice Fund because I overlaid the Vice Fund on Portfolio 21. And what you'll see here is that they both outperform the market. So if you want to be an investor, you could choose Portfolio 21 and the Vice Fund and outperform the market. But why would you do that or not do that? So we calculate HIP scores. That's how we drive our portfolio. We quantify the human, social, and environmental impact. And so we're showing here the weighted average HIP score for Portfolio 21, the Vice Fund, and the S&P ETF. So as you can see, Vice creates less positive impact in the world, and Portfolio 21 creates more. To speak to the street and to the institutional investors, we also labeled the alpha. Alpha is the risk-adjusted return. How much risk are you taking on for this return? So Vice does have a positive alpha. Portfolio 21 has a higher alpha. So again, question what you want for your portfolio. These are the sources of information. So you can go to Thomson Reuters Asset 4 Product, Bloomberg. We talked about lobbying before. If you go to opensecrets.org, you can find out who's lobbying who, which executives and funds. There used to be something called the Blue Fund that went out of business after 2 years because they couldn't get over 10 million in assets. Sustainability is going up. And so this is a graphical representation of the available sustainability information. These are some of the leaders who've been out there. And this is the performance of the HIP 100. Again, past performance is not indicative of future return. You can check it out on the HIP Investor website. Also, sorry, that's not a sponsor. NASDAQ has put together a CRD index with Michael Mulliot. This is the performance of the QCRD index. It is not yet a portfolio that you can buy as an investor except through a separate account. So that is something that you can find out on the website. So we'll end here on Ada's learning so far. But I hope you'll see that investing in human, social, and environmental impact creates and enhances shareholder value. And it does not erode shareholder value. And so we hope that you vote with your wallets, vote with where you work, vote with your investment portfolio, and most of all, vote in the election so that we can look forward and have a striving economy and don't relinquish the #1 spot in the US, that we're as strong as our partners in China, India, and Brazil. Thanks.
We'll have 1 minute after.
Now, guys, we have come to the end of our time, but I think unless, Dirk, you want me to end right now, we should open it up for at least a few minutes of questioning. That work? Okay, and everybody remember to vote. I think, do we have the voting slide? Because I think people who didn't vote, I think we were going to take a second vote after the debate to see how many people have been won over by either side. Jerry, were you won over? Were you feeling guilty?
No, I didn't vote before, so now I can.
Okay, excellent. Perfect.
I'm from Chicago, so I'll vote again.
Who has got a question from the floor?
Yeah, Steve Granger from the Centre for Safety and Health Sustainability. I was rather disappointed to learn only very late in the discussion that you introduced the topic, John, of the moral issue here. We've heard of it in a previous question in the forum this afternoon. And one thing that concerns me is it seems as though we haven't really recognised of where the word sustainability actually originated. And if we go back through 20, 30 years of serious industrial accidents, you know, we think of incidents like Bhopal and so on. Sustainability hasn't been generated by the markets and so on. It's been generated by shareholders. And I think what we're starting to see is a very smarter investor and client base where if you think about things like technology, the knowledge of what's happening not only within our own boundaries but elsewhere, and the rapid leap of things like Arab Spring and how that has changed not only corporations but countries and governments and so on, there is no option but to take sustainability incredibly seriously. And one thing that worries me is that sometimes we look at the statistics that you've presented here and they don't necessarily tell the true picture. We formed an organisation to look at occupational health and safety, and what's very clear to us is that there is no way of measuring that across the world. One thing is for sure, though, my institution itself has actually just caused the UK government to do a U-turn, complete U-turn on its stance on health and safety. They were not taking it very seriously, perhaps putting lip service towards the sustainability agenda in terms of health and safety, but now they're very much for it. So I thank you for bringing the moral argument to the equation, but I was rather saddened it didn't appear earlier on.
Anil, no option for corporations then to take sustainability seriously?
No, I think companies have to take sustainability seriously. But I like your comment about morality. Morality is in the public domain. And it's the job of the government to figure out what the common norms of society are. And I think one of the problems with the CSR movement is fiercely anti-political, anti-government. I think it's telling that in this room, there is no representative from the EPA or OSHA or the government. We cannot talk about morality and safety standards without bringing the government into this picture.
They don't have the money to travel to.
All right.
But I think the state, Chris Balderson from the State Department will be presenting. I'm not sure if Chris is here now, but will be at the conference.
Who else?
Hi, Robert Nash with Compass Energy. With the sustainability question, I want to talk about going public. On CNN a couple weeks ago, Steve Case, AOL founder, mentioned that before they were public for 7 years, they had 200 employees. Of course, once they went public, the next 8 years, 10,000 employees, multi-billion-dollar, because going public creates capital and it creates job creation. And what Steve Case happened to say a few weeks ago was that this country right now should be making going public much easier than it has been to create job creation and to create capital within the company. So having said that, if more companies were able to go public quickly and easier, wouldn't that create more of a responsibility for current public companies losing capital investment to other newer companies?
Okay.
Sure. I think what you're pointing out at a broader level is that entry and exit market forces can get companies to behave in a way which improves shareholder value. So your point is, let's improve entry more companies come public, and that will get the incumbent companies to act better. I think it's slightly dangerous to going public by itself is not the source of creating new jobs. It's a particular critical size of the firm that requires it to attract more capital. You can't simply take a firm and put it on the exchange and create more jobs just by doing it. I think the fact is, in the economy today, we don't have enough firms that are growing at that rate, that need that kind of capital, and at the cost that the capital is today. So I don't think the solution, but I do think that the multiples to companies that are going public today are higher if they have better social standards than if they don't. So there's evidence for that today, which means that if I'm a private company and I'm taking my company public, and if it turns out that I'm paying attention to safety standards, I do get higher multiples. Let me give you a specific example. When the BP accident happened, so we were not trading BP because we were just trading the US domestic stocks. But our portfolio benefited from the BP accident, which to me was fascinating because till then I had seen all these correlations that Paul pointed out, but they were correlations. It's difficult to actually see what mechanism is driving it. But when the BP accident happened, all the firms that had better safety standards fell lesser, and the oil and drilling firms that had worse safety standards fell more. So my portfolio was exposed to better safety in this sector, and we made money from that reaction every firm had to the BP incident, which I thought was fascinating because now you've actually seen one event that has happened across one of these many oil companies actually generating profits in a portfolio which is not even exposed to that company. So I think the key factor is all these metrics will slowly become important in various kinds of events. IPOs being one such event, takeovers being another such event.
Is that persuasive to you, Jerry?
Well, I would say there's a reason why we're not going public. We have Sarbanes-Oxley. We have a tax code. No one would want to bring a company public here if they could bring it public elsewhere. So we do need to address, it is good for companies to grow. It is good for companies to come out.
But hold on a second. I thought that Anil said government regulation is okay.
Well, if
because
you
it's
run a
government's
neutral-
responsibility to set the rules for the society.
Yes, and government tends to always go one step too far. And right now, there's a reason why we have more people would rather list in London or other exchanges, and they would like to avoid our corporate tax system.
Well, on
Just
September 15th, the U.S. House of Representatives debated crowdfunding, so where individual citizens can access that. So that there is actual government discussion around it, and Rhode Island representative is facilitating that discussion with the SEC. Also, the SEC is not requiring mandatory carbon disclosure. They say it's material, but not material enough to be mandated.
But what about Vinay's point that there are higher multiples for firms that practice higher safety standards? Is that persuasive to you?
If it comes out in the wash, if in the long term it can be proven, it can. But I think having a multiple today is a bet on tomorrow's earnings. And you might end up coming out with a higher multiple, which means all the people who help fund it sell at a higher price. But if it doesn't become a reality, they make out, and the people who came in at the beginning, because as my Frank Zappa quote works, there's a lot of stupidity out there. If they run into it, they're the ones who are going to get hurt. So I think.
Well, just to follow up, we kind of got off though on what I wanted to point out. The answer I'm looking for is that not whether a company, is required to go public or if they deserve to go public. Excuse me. There should be easier ways. Like we now know there's private distribution, self-offerings. More companies are looking at to where they can offer their stock to the public before getting their ticker symbol and hitting the IPO. But my question that I want answered is, if a company is able to go public and it creates more companies going public, won't that create more, responsibility for just that fact alone? Because now other companies that are currently Fortune 500 are public. And remember, all Fortune 500 companies started as startups. They started as new companies.
I'm going to get a quick answer to your question, and then we got to wrap it up because we're out of time.
I think companies going public is a good idea, but it opens up a different issue, which is an agency problem, which is there are shareholders and there are managers. If it's a private company, they're aligned. In a public company, managers cannot follow their own whims. They have to follow the interests of the shareholders.
Guys, can you join me in thanking our panelists, our debaters?